By the end of June last year, pension funds in the country had about $9.63 billion in assets under management. Now, just over a third of that was invested in government securities in Kenya, another 21% or so in real estate. Private equity had a tiny slice of the pie, barely $2.5 million. But consider this, that was 47% more than the same amount in December 2015. So convincing more local pension funds to invest in private equity, that's one of the topics in focus at the annual conference of the East African Private Equity and Venture Capital Association. Earlier on, I spoke to the association's chairman, Ayisi Makatiani. I started by asking why pension funds now are starting to warm up to this asset class.
So a few years ago, Ascent Capital got maybe about $4 or $5 million. This year alone, I would almost say that we're probably getting somewhere between $30 to $40 million in commitments from local pension schemes. That's a big jump. Over the next 5 years, we want to make sure the local pension schemes are able to put $500 million into private equity. We think it is possible. The pension schemes have about $10 billion today. They are allowed by the law to invest without going back to RBA for approval to put up to $1 billion. They've barely scratched the surface. Over the next 5 years, it's growing at almost 20% per annum in terms of assets under management. We would like to ensure that the proportion that's been approved for private equity grows. It means investing in local private equity, international private equity, regional private equity.
What has changed in the attitudes in pension fund boardrooms in that 3-year window? Is it that now they better understand how private equity and venture capital works? Do they have a greater appreciation perhaps of the returns that are available through funds essentially like yours?
Yeah, so a couple of things happened. One was, of course, Ascent came and they spent a lot of time educating. A lot of the private equity investors, fund managers have been working very hard to educate both the trustees and pension scheme managers and the asset managers who control those assets. So that has been fairly active over that period of time. The government allowed the RBA, the regulatory body, to open up private equity as an asset class, which basically means that if, as a pension scheme, you have your documentation specifying that you can invest in private equity, they'll allow you to be able to invest up to 10% of your assets in private equity without having to seek any further approvals. So that made it easier for pension schemes to make the decision. And the other one is the stock exchange 2-3 years ago did pretty badly. And all of a sudden, when asset managers had to explain on a quarterly basis what happened, they found that sometimes walking into that room when the managers, when the trustees are very angry with you, it's always good to have another option that you're trying to sell to them, and private equity looked good. Private equity was exposing and it is exposing a lot of pension schemes to asset classes that are not available on the stock exchange.
Right. Let's step back though to essentially what private equity does, because if you look at the sort of businesses that we're talking about, healthcare for instance, some businesses, and I keep hearing this from businesses that have either dealt with private equity or been approached by private equity, and I see this increasing reluctance to give up equity in exchange for essentially giving up a stake in the business in exchange for capital from PE. Yeah. But where's the debt side of the equation coming in? Because that would be perhaps at face value of sort of middle ground between both parties.
Yeah. So look, most businesses understand debt, mostly from banks. The banks have been players, other than in the last 1 year because of the rate cap at 14%, which meant that a lot of the smaller players whose risk couldn't qualify didn't get the money. But debt is easy to understand. Equity is a lot harder to understand. Our job as private equity investors is to ensure that we are able to explain the benefit of private equity. It is equity investment. We are coming in, we will sit with you at the table like, you know, family, as opposed to a bank that will take your collateral, and if you don't perform, they sell it. It means we take a higher risk, but it also means that we want a lot more control. A lot of entrepreneurs and families don't understand that, so we have to educate them. We have to show them the differences between debt and equity. Then we participate.